Welcome to the ISG quarterly webcast summarizing the second quarter of 2016. This quarter's webcast is entitled Chasing Yield, Central Bank Policy and Market Distortion. My name is Howard Coleman. I am the Chief Investment Officer of Coldstream, and with me today is David Powers, the Portfolio Manager for Roger Reynolds' team. David will be providing a market recap, and I will present our special topic, which for this call is on the distortion that central bank policy is causing in global markets, resulting in an unprecedented hunt for yield. There were two other highly interesting topics that occurred during this quarter that we will not be discussing. The first is Brexit, and we have sent two communications on this subject previously that covered our thoughts, and we really don't have much more to add on this point at the current time. The second, of course, is the election and its potential impact on markets. However, we're going to be having another call in October prior to the election, and we may well address that topic at that time. For this call, as all calls that we do, there is a box on your screen where you can type in any questions you might have. We will try to address all of your questions today, but if we do not get to all of them, please contact your relationship manager or your portfolio manager with your question. While we have scheduled this call for 30 minutes, please bear with us in the event we run over by a bit so that we can cover these topics thoroughly for you. David now will give the market update. David?
The first slide here gives us two looks for a variety of asset classes. The first shows numbers at the end of the second quarter. The second is through the middle of this week. We provide the latter so you can see the dramatic increase in returns since the Brexit vote, but more importantly, we'll hopefully keep you in a positive state of mind as I deliver my remarks in what has become my signature EORIC message. If we focus on the 630 column for the second quarter, you can see that the returns were strong for the majority of asset classes even before the recent melt-up. U.S. stocks, which represent the first 5 rows, posted adequate returns with mid-caps leading the way. On the international front, developed or the EFA row has continued to struggle, but emerging markets has had a nice bounce back after a difficult 2015. Bonds were also impressive, specifically on the international and the high yield front. Even alternatives have pitched in with commodities and real estate doing very well there. Fast forward a few weeks and move your eyes to the 726 column. You can see that there's been a massive positive move in most of the risk asset classes, some moving as much as 4 to 6%. But if you continue to look down, even the bonds have done real well, and real estate has also picked up some returns. The point of all this is that the notion that there are no other alternatives out there to large cap U.S. equities has not held true, and that a diversified portfolio of asset classes has served you well in the first 6+ months of the year. Digging deeper into the asset classes, just start with the S&P 500, which represents the large cap equities. We go back to 2015 here. I just want to show you kind of the framework of basically just a flat line from 2015 all the way up to about 630. But you can see since the Brexit vote, we've had a significant increase in what's gone in the S&P 500, certainly giving us a lot of positive momentum, very encouraging to break through the 2100. What we'd like to see, and which is represented down in the blue shaded area, which represents volume, we would like to see this up a little bit higher, but it has trended a little bit lower. Some of that is obviously seasonality, but again, for some more conviction in what's going on from a momentum standpoint, we certainly would prefer to see a little bit more volume. What isn't encouraging, though, on the flip side, is what's going on in terms of valuations. Earnings just have not kept up with price increases, and you can see that in this chart here. Basically, the red line is representing price to earnings ratios, while the blue line is representing price to sales. We use both. Price to earnings, obviously a more conventional metric. Price to sales, though, gives us a look at the revenue side of things and is can't be manipulated as much as the earnings can. Either way, you can see from here the long-term average for P is about 16.5. The S&P right now is upward in the 20 mark, and price to sales is all the way up at 1.93. The price to sales is actually well above not what it was in the 2007-2008 range, and is now getting closer to where it was in the tech bubble of 2000 and 2001. One argument that we do hear about this is that, well, given the level of interest rates, PEs should be relatively high. If you don't pay attention to anything else I say during this, the most important thing you can remember is that is pure rationalization. There's actually no statistical proof that level of interest rates should make a difference on where PEs are. It really is just a rationalization to keep PEs at a higher level. So I do want you to pay close attention to that. Moving down, just kind of take a look at another argument we hear on why PEs or why the market's fairly valued is taking a look at the individual sectors. The argument being, well, if you strip out energy and you strip out consumer staples and you strip out utilities, the market's actually under or fairly valued. And I guess that holds a little bit of water, but if you look across the averages, which is the black lines here that we see for each of the sectors and where those dots are plotted, there isn't any that are below their current. There are some that are on it, but there are certainly more than a few that are above their level. So even if you strip out those asset classes, which obviously you can't strip out sectors, that doesn't make any sense, but if you were inclined to do so, you would see that the market is still a little bit on the high end. So where does that put earnings for us? Are the earnings going to be able to catch up to the prices that we currently see? The chart that you're looking at on the left-hand side takes a look at operating earnings, basically going back to 2013. Obviously, a good spike through 2014, and that led the market up. But since basically the middle of 2014, we've had 6 straight year-over-year quarters where operating earnings have come down. And if you look on the chart to the right, what does that mean for the third quarter? Estimates started off very good in the beginning of April. Looked like it was going to rise, roughly within the 3 to 3.5% range. That has slowly come down to now where we're posting close to a negative print, if not negative print. So it does not look like the third quarter, as most people were hanging their hat on the second half for earnings, it looked like the third quarter was going to be where things would start to ramp up. That doesn't look like that's the case now. Estimates for the fourth quarter, the last time I saw, were roughly 9%. So certainly we can look forward to the back end of the year. But for now, earnings just haven't been able to keep up with what's going on in terms of price movement. And just a quick other note on earnings here, very important note, James brought this up in the last presentation that we had last quarter, and the difference between GAAP earnings, generally accepted accounting principle earnings, as well as operating earnings. And there's a difference between both, and there's a reason for that. GAAP earnings is your actual measure. Operating earnings add back generally one-time costs, such as merger and acquisitions, layoffs, stuff along those lines, and non-recurring costs, and that certainly a fair estimate, and that's why we do look at operating earnings, because it does smooth things up a bit. But one thing we're noticing recently, and you can go back to the 2000, 2001 era, you can go back to 2009, and here we are now, is the massive divergence between what we're seeing in GAAP and first call earnings. Not to be too dramatic with the word massive, but it is a large gap, and those cycles, those were the end of cycles, and what you see at the end of cycles are a lot of mergers and acquisitions. You see a lot of layoffs. Anything you can do to keep earning levels at a relatively higher pace to justify valuations, and that's what we were seeing again this time around. So we're certainly cautious of late end cycle, kind of accounting things that we're seeing and paying close attention to that. Moving to the small cap side of things, the chart here has been pretty attractive since the January lows. We haven't quite got back to the highs, but momentum here has clearly been moving. Certainly, small cap has been one of the strongest asset class, as has the mid cap space since the lows of January. But the one thing that we're having a hard time reconciling is, even though we haven't made our ways back up to the highs, you could see that small cap valuations are still well above their norm. So even the massive move that we've seen so far this year, PEs and price to sale on the small cap index, the Russell 2000, just haven't quite kept up. So this is I'll stop here for a second. This is kind of the struggle that we have when we're determining tactically where to go within asset classes. Is we've got some nice momentum moves, but at the same time, valuations are giving us a little bit different story as well as fundamentals. So certainly a balancing act for us here, and something that we constantly struggle with. But it's important to know that these are the things that we're taking a look at, and we take a look at them very closely. Moving on to the international side, this chart has not been as strong, even with the strength of the dollar, which I'll picture a little bit later. The MSCI EFO, which represents our international developed index, has kept pace with the other indices, and for obvious reasons, from an economic standpoint, but also some political issues, Brexit vote, a laundry list of things have kind of kept this index down. And the big question we always get is, why international investing? And we've kind of developed this chart here, rolling 3-year relative outperformance of U.S. versus international. Anything above the line represents U.S. outperforming on a rolling basis. Anything below the line, international. And obviously, most memories are from cycle to cycle. And obviously, since 2009, this has been a generally strong move on U.S. outperforming international, and we certainly can understand why investors get a little bit frustrated. But if you look back to the history, and we have back to 1992 here, there are some pockets, and those pockets exist for a significant period of time. Thing is, we don't know when these are going to occur, and that's why we keep global portfolios going. But to put this into magnitude, time to take a look at another chart here that we put together. We introduced this probably last year. Basically, rising line means U.S. outperforming, falling line means international outperforming. And we put some trend lines here, or some deviation lines here, the red lines. And you can see that the solid red lines represent 2 standard deviations. And what we've seen basically since 1970 is that you really haven't moved past the 2 standard deviation number. It really gets right to that number and then starts to roll over in favor of the other asset class. And that's generally on relative valuation. We've actually now gone through that, and actually gone through that a significant amount. So this is a rare occasion for U.S. outperforming international in terms of the legs of this and the magnitude, but it is important to know that these things can reverse, and usually do reverse at the 2 standard deviation mark. One asset class that's actually starting to do very well, and one that we're starting to get a little bit more encouraged about, is emerging markets. 2 reasons. We've seen this chart move up significantly, and actually have gotten closer to its November highs. Is the Fed has decided to move off the stance of raising 4 times this year, which is weakened the dollar, and it's also raised commodity prices, which is usually good for emerging markets. The other aspect is valuations, which I don't picture here, are quite attractive when you look at the other equity asset classes. So there's some good momentum here, as well as some good valuation metrics that have kept EM moving forward. Just trying to take a quick look at the dollar that I just mentioned here. As you can see that this is kind of going from January. You can see that the dollar has weakened considerably as the Fed has come off its stance. It's increased a little bit here, obviously with the Brexit vote and stuff along those lines. The dollar did gain some momentum, but it looks like we've flattened out here, and it looks like now for basically since May, everything's been running on its own merit. And also commodities, which also helps emerging markets. You can see that obviously a very precipitous decline since 2014 has reversed course here at the beginning of 2016, and again is up about 13% this year. Just a quick note on oil: it actually has rolled over a little bit, has gotten close back to the 41 range. Something we're paying close attention to. Equities haven't stayed as correlated as they did in the beginning of the year, but still, I think if we started to move down into the 40 or back into the 30 range, that could cause some difficulties for earnings, certainly on the energy side and the overall market as well. Shifting gears, moving to the fixed income side of things. Obviously, with equity prices doing extremely well, this is not a relationship we would expect to see. This yield curve continuing to flatten, and you can see basically over the six month window here, we've dropped considerably. The 10-year note. Taking a look at new lows for the 10-year. This is basically the 10-year Treasury and where it currently stands, below where it was in 2008 in the financial crisis, and now well below that, and now below where it was back in 2012. And so something that we're generously cautious about. The fixed income market usually tells you something, and it's usually that equities aren't going to do particularly well, or the economy is going to struggle, and we just haven't seen that. It's been an actual reverse of that, and that's shown here on the next chart. Basically, we take a look at, we kind of overlay the 10-year yield, which is on the left-hand side, and the S&P 500, which is on the right-hand side in red. And what we would anticipate is that as equities rise, we would expect yields to rise, just given the inverse correlation. And that has not happened. They've actually materially moved in the, basically, yields have come down while stocks have continued to rise here in the first half of 2016. It's not like it hasn't happened before. You can see in 2014, we kind of went through the same relationship, but then we were stuck with basically 2 years of a sideways to somewhat volatile market, and we're wondering if that's where we're headed going forward. Do we borrow too much here in the first half of the year, given the level of interest rates that we're currently seeing? So something we're paying close attention to. Before I shift over to Howard to focus on really the main topic today, I do want to talk a little bit about the economy. It has been muddling along, to say the least. Kind of taking a look just at the first quarter, which is on the left-hand side. You can see that the Atlanta Fed, the GDP Now forecast, is usually the best forecaster, and that's why we pay close attention to it. You can see that they came in at about a 0.4 print for the first quarter. Obviously not very robust, growing, but again, not very robust, and something that would cause a little bit of concern. Switch over to the second quarter, a little bit better. If we had this conversation yesterday, this would have looked much better. The Atlanta Fed had it at roughly consensus right around that middle two number. 2.25, but we did get a reading today that pushed that down to 1.8 based on some trade data. So, timing is everything, I guess, but still growing at 1.8, first quarter at 0.5. Not terrific, but it has been something we've been seeing pretty regularly for the last 3 years. First quarter difficult, second quarter showing a little bit more strength. What it does is give us confidence that we're going to continue to muddle along here, and that 2016 probably isn't a recession year. The probability of 2017, given the fact that if we move on to the leading economic indicators here, you can see when they start to roll over, which we haven't done yet. This is basically kind of gone in a sideways movement, so it hasn't rolled over quite yet. Once it starts to roll over, you usually get a 12 to 18 month window before we head into recession, and we just haven't seen that yet. So pay close attention to leading economic indicators, and then when they do start to roll over, it could be something that can cause us to get a little bit more defensive. But for now, given that we're muddling through and given that the indicators haven't quite rolled over yet, we think that 2016 is certainly safe, and into 2017 should be good as well. Also taking a look at the economy, the unemployment rate continues to go down. We'd have to say at under 5, we're at full employment. One big note that people make is the participation rate has come down, and that does affect the unemployment rate, but that's even stabilized and has started to move up. So from an employment standpoint, things look pretty good on face value from what we're seeing. And so we've got a muddling economy. Things look pretty good on the employment from a face value standpoint. Why can't the Fed get off their interest rate movements? Obviously they point to global issues, and that's certainly, those are well known. What I want to provide for you here, we want to provide for you here, is maybe some other issues that are going on here under the radar that are causing the Fed to kind of pause a little bit more than they're expecting. The chart that we have here on the left-hand side goes back to job creation since 2007 to basically the middle, to the end of 2015. And what we're seeing is manufacturing, even though employment's up and jobs have been created, manufacturing workers have actually lost jobs to the tune of about 1.4 million, while waiters and bartenders, and this is really to represent lower wage type of employment out there, has actually surged, and is where a good majority of the jobs have been gained. So the Fed is concerned here. There's certainly slack in the job market. Those middle class manufacturing jobs have certainly gone away or haven't been recovered since the great financial crisis. But what we are getting are low wage jobs, and that I think is a concern. If you also move to the chart to the right here, you can see that the 55 and older crowd is generating the majority of the jobs, growing at roughly about 7 million, where your thoroughbreds, I guess, if you will, your 45 to 54, your 35 to 44, this is where you kind of create your earnings and you're working your long hours. And those jobs have just, those have eroded a bit to the tune of about 4.2. And this is, again, something that's causing the Fed a little bit of concern, is that age group that you need to work hard and do well has actually lost jobs. So I think these are two things, or we think these are two things that the Fed is taking a close look at and kind of putting them on pause. And this just kind of goes to the slack in the market. You can kind of take a look here. Another reason why we think the Fed may be holding is consumer spending. We are a consumer economy, represents well over 70% of the economy here, and that has started to roll over a little bit. Not too bad, but it has started to roll over a little bit, and certainly causing concern. But if you kind of take a look look in the components, it's not always the headline number, it's the components we want to pay a little bit of close attention to. And you can see here the blue line is the retail sales, and that continues to trend lower. And what you can see, though, in the red line is that the healthcare expenditures have continued to move up. Now, all this falls within personal expenditures, but I think we can all agree that from a healthy consumer standpoint, we'd rather see retail sales start moving up as opposed to healthcare costs moving up. That's generally not representative, no pun intended, of a healthy economy. So I think we think those are some things that the Fed is paying close attention to, why they're maybe staying on hold outside of what's going on from a global standpoint. And with that, I'll move it over to Howard to talk a little bit more about the main topic of the day.
Thanks, David. Today I'm going to talk about the impact of central bank policy in the U.S., Europe, and Japan on financial markets. The basic issue that Fed policy has supported since the financial crisis has been the equity markets. And if you can look at the bottom of this chart on 2009, right around the time Fed announced QE, the markets began to rally. Now, this certainly wasn't only due to QE. At that point, unlike now, things were extremely undervalued. Babies had been thrown out with bathwater, and there was excellent value. And QE1, I think, without question, provided an important stimulus to the economy. If you can go beyond and look around 2011, you see the Fed announces QE2, where you're having a recovery, and it does help, and then it falls off again. And you'll remember the Fed then announced Operation Twist, which was buying 10-year treasuries and selling 2-year treasuries to keep 10-year yields down as a way of stirring the housing market. And then Fed has announced QE3, and we continue to see more and more esoteric central bank policies out of Europe and Japan, including negative interest rates, which we'll talk about later, and buying private bonds, which we'll talk about later. If you recall, QE, one of the major things QE did was it bought government bonds as a way of keeping interest rates down. And it certainly has worked in spurring the equity markets. What's more questionable is after the initial period of 2009-2010, whether it's had a significant impact on spurring growth. And here we see charts for the US GDP, Euro area GDP, UK GDP, and Japan GDP. Now, you can see that really since 2010, every economy's been in a range. Now, these are clearly different ranges. With the US, we're looking between at 1.1% year to date now, estimates through the second quarter. And steady around 2% growth. These are quarter over quarter, not annual growth, so they're a little different than what you're used to seeing, and there's a little bit more noise. If it was annual growth, you wouldn't see declines since 2008. But this is quarter over quarter, and you see it within a range from quarters in the US from 0 to 4, from the UK from 0 to 1, from Japan to 0 to 2, and Europe from 0 to 1. Not exciting growth at all. Now, those who think that would argue in favor of QE2 and QE3 having a significant impact would say, well, you don't know what would have happened without them. But I think fairly clearly, at this point in time, the more stimulus, the bigger the hammer, the less the effect. Much bigger effects early on, less effects now. And I mentioned the new arrow in the quiver of especially Europe and Japan, beginning in 2014, is something that the world really has never heard of before, and that's negative yielding bonds. Negative yielding bonds started in 2014. Before 2014, this 9.31 trillion number would have been negative. 9.31 trillion, let that sink in. That's an unbelievable amount of money. That's the negative bonds issued in the developed world, primarily Europe and Japan. This is started by the European central banks imposing what's called negative interest rates. Banks have to keep money on deposit with the central banks. It's called reserves. It's a mechanism to keep banks from going under. They have to keep cash there in case there's a run on the banks. Depression era policy. But historically, banks have received interest for leaving their money on reserve. But the European Central Bank decided in 2014 that they were going to make the banks pay interest, to force the banks to keep the minimum amount on reserve, hoping that they would lend, hoping that people would borrow, and hoping that the economy would then be stimulated. Really, we'll see there hasn't been a ton of bank lending, and it really has been on the demand side. And there's a lot of evidence that what's happened in Europe and Japan is actually hoarding, not borrowing. I don't have any confirmation on this, so this could be urban legend, but I certainly have heard from 3 or 4 different sources that what has been record sales in Japan is safes for people to store their cash. Again, I can't confirm that, but I have heard that from different sources. The other thing it does is cheapen the currencies. And everybody's looking for cheaper currency now to encourage their exports. So what has that meant for government yields? And we see this takes into account a yield minus the inflation rate. So it's the real interest rate you're getting on government bonds. And we see the U.S. real yield, and this is a measure of inflation to date in the U.S. This year by the CPE measure, and the real interest rate is 54 basis points, 0.45%. Switzerland, it's actually negative. Germany, it's negative. And Japan, actually, even though they have negative 10-year yields, their deflation is so significant it results in a certain positive yield, which is why people in Japan would buy the 10-year treasury, because actually with inflation, it becomes a positive yield. By another measure of inflation, the core consumer price index, the 10-year yield in the U.S. is actually negative as well in terms of real yield by 79 basis points. Europe is starting a new program. I mentioned that earlier, and that is they are now buying corporate bonds. Prior to that, in Europe and in the U.S., by mandate, they cannot buy corporate bonds. By Europe, they could, but they never did before, but now they are buying corporate bonds. They're now past the peak of the amount of euros that the central bank has on its balance. This will increase dramatically over the next year or two as they continue dramatically to increase their QE. Both Japan and Europe are a couple years behind the U.S. on their QE programs. This has resulted in something we've never seen before, which is a negative yield on a corporate bond. Now, this corporate bond does have ties to the German municipality, so there is some sense that there's an implicit guarantee, but nonetheless, it is a private company, and we have historically never seen negative yields on a private corporate bond. Now, this shows cash flows into the U.S. for fixed income. The first chart shows private foreign investment net flows into U.S. fixed income, and the other shows corporate bond ownership. And we can see how foreign flows both into treasuries and into corporates. The blue line on the left is treasuries, the brown line is corporates. We can see that there has been significant foreign inflows, and in terms of the right chart, corporate bond ownership, 26% foreign. That's because you can get the highest yields out of any other developed market in the U.S. than you can in Europe or Japan, and so money is flowing in. This will also, because of these flows, keep a cap on U.S. interest rates as long as European and Japanese rates remain so low, because foreigners will continue to invest in our treasuries and corporate bonds to get the slightly higher yield. So what has these low interest rates meant? They wanted to allow corporations to borrow, and the idea was the corporations would spend. They would expand research and development. They would do a bunch of other things. And indeed, corporations have issued an enormous amount of debt. This is U.S. corporate bond issuance as a result of QE. And we can see the yellow line being the total, the red being high yield corporate, and the green being investment grade corporate. All of them have increased. Now, the current year line is lower than 2015, and that's really because we're only halfway through the year. Throughout the full year, we may not reach 2015 levels, but it will come close. So corporations are using these low yields to lever up and borrow. What are they doing with this borrowing, however? Are they spending it on research and development? Not so much. One of the things that has boomed is they're using this cash on their balance sheet for merger and acquisitions. We have a booming merger and acquisition market with people using the cheap cash to buy other companies. Whether this ultimately has pro-growth implications, that's in the eyes of the beholder, but it's certainly not pure research and development spending or hiring. This is the most interesting chart, I think, of what corporations do with their money. They are borrowing money to buy back equity. And this chart shows the changes in corporate debt and net buybacks of equity. This is shrinking the pool of equity, increasing the pool of debt for companies. So now there are less and less stocks for you to invest in as the pool of stocks shrinks with buybacks. And I don't think this was in the Fed's mind as the ideal prescription for the use of the cheap money, but it certainly makes sense from a corporate point of view. From an economic growth point of view, maybe not so much. And what is have these shares been replaced in the IPO market? Not so much. IPO issuance in 2015, 2016 is paltry. And it's paltry for a couple reasons. One reason being the cheap cash has spurred the private equity industry, and a lot of private company valuations are much higher than their public counterpart. Spotify and Pandora, before Pandora got acquired, the difference between the valuations of that was enormous, with Spotify being 5 or 10 times more highly valued as a private corporation, given private equities are chasing what they call their unicorns. So the buybacks have not necessarily been replaced by IPOs. So we have shrinking equity and increasing debt in the markets. What has happened with spreads? They have come in quite a bit. These are high yield and investment grade spreads. In May of 2015, they were relatively tight. In January and February, when we had the markets crashing, spreads, not crashing, but falling significantly, spreads widened, and they are now tight again. These are high yield and investment grade spreads over treasuries. What else has it done besides attracted people buying bonds? Any equities with high yields have been used as a substitute for bonds. So if you can get a 4% or a 3.5% dividend and you need income, let's buy that stock. Let's not buy the bond. And we can see valuations on utility companies which pay high dividends are ridiculously high. And when you saw David's chart, you saw that they're at historically high levels. And this is very much the same as the purchase of bonds, a search for yield. Buying yield wherever you can get it. The danger is if the Fed does raise and this reverts the other way, it could fall very, very quickly. REITs are another high yield paying equity. And this has run as well, maybe not quite to the extent as utilities, but they are still significantly overvalued. Equities with high dividends are all pretty much universally at a premium right now. One of the exceptions, one of the things that we still continue to be bullish on are MLPs. MLPs do have benefited from the search for yield, but they are also correlated with the price of oil. They have recovered, but their valuations are much more reasonable. They're still returning sometimes 8% with some of these MLPs because they have been that equity correlation. Now, as many of you know, we like midstream MLPs, which are the MLPs that own pipelines that oil and gas flow through, and they are on long-term leases, so they should really act more like a utility, and they shouldn't really respond to the price of the commodity. But the reality is in the markets they do, which does create volatility for the holder, also creates opportunity because this is one yielding asset that maybe hasn't been quite as badly affected by Fed policy. Final slide just gives you some potential sources of yield that we still have some confidence in. One is municipal bonds, high yield municipal bonds. There's been contagion, for example, from Puerto Rico into high yield bond markets generally. Now on this, you have to be very selective, because if you're not selective, you can get hurt. But if certain municipal bonds still have value, MLPs, and then there are alternative sources of yield. One of the ones that we have advocated is reinsurance. Although it's not nearly as attractive as it was 2 or 3 years ago, it still is on a relative basis, a relatively attractive source of yield. Of course, these are suggestions, and please consult with your relationship manager or your portfolio manager regarding your specific needs. So in sum, there's been a significant distortion, obviously, with negative interest rates, with low-yielding bonds, and with overvalued high dividend-paying equities. So it is more challenging to find pockets of value. They are there, but it certainly is a more difficult investing environment in the fixed income space. So that concludes our quarterly call. We have no questions. We have no questions. Thank you. David's reminding me that we have to show the disclosure page, which for compliance reasons we are doing. But thank you very much for your time and your attention. And please contact your portfolio manager or your relationship manager with any further questions you might have. Have a good afternoon and enjoy the weather.